Well, thanks for having me. I don't know what you want. Do you want me just to sort of just start going and tell you about the book and the genesis of it? So as Jill mentioned, I was a reporter at the Mobile Register in South Alabama on the Gulf Coast at the start of my journalism career, and focused a lot about the biggest story in town, which was a lot of real estate development at the time. This was 2004 and 5 and that sort of those boom times before the housing crash. And then, years later, I've since become a reporter for the Wall Street Journal. And I read about all sorts of things like the price of oil and the natural gas markets and timber markets. And one of the things that we now these days, and it's sort of very telling about this conversation, is we sort of consider the single family home, since the housing crash has become a sort of investable commoditized asset, or at least treated as one, increasingly by investors large and small. So I write about rental homes the same way I might write about something like a toll roads or pipelines or any of timberlands or any of these other sort of income producing assets that investors buy, which is very fun because housing touches all of us and is such a vastly interesting topic, and there's some great sort of natural tension that us reporters and writers like to key on. And one of those big tensions is the way that homes, a house in the suburbs or anywhere really, can be viewed with like sort of two different viewpoints. One is an income producing asset, a financial asset, and the other is a home. And so that there's sort of two markets for that same property, and of course you get the tensions attendant with that. The book sort of starts with me buying a house as a young person, fairly naively, and sort of goes through my decade plus trying to sell the house, which was, as Jill mentioned, badly underwater, worth a lot less than I paid. These are much more modest numbers than you all are used to in California. But that sort of, with that idea and that story, my editors at the Wall Street Journal, they didn't really know that I had a house in Alabama, that I was a landlord from a distance, and sort of told them my situation. Then a couple of years ago, that I was trying to sell the house. And, they were like, well, that'll be perfect. That's 10 years since the crash. We'll use that as a story about 10 years, the decade since the housing crash. And that sort of spawned the book. And we folded in the reporting I've done since on the rise of the sort of what we call the Wall Street landlord or the mega landlord, these companies that came out of that rose from the foreclosure crisis, owning tens of thousands of homes. Jill, do you want me to, I'm not sure if you wanted to ask me questions or particular aspects of the story that you'd like me to focus on?
We'll get to some questions, but first go into a little bit more detail, because this is all great information, and you're kind of a rare source for not only are you hands-on in dealing with this, but you're writing about it. So please go ahead.
You want me to jump forward to today and what we're seeing in the housing markets with these large companies and investors?
Yeah,
okay.
Yeah, we'd love that, and throw in any history you like.
You may have them in your neighborhood. They're in a lot of California markets, although increasingly California homes these days are sort of don't really make great rental math for landlords. The price of the home is too much on the front end. But when home prices collapsed around 2007 or 8, they kind of kept tumbling, and it wasn't until about 2011 that home prices really hit rock bottom across the country. Some markets before then. And what happened is big money on Wall Street, billionaires and huge firms that invest in property like shopping malls and warehouses, apartment blocks, all the sort of other properties that you can invest in, we're looking at the landscape, and they said, look, you can buy a lot of houses for pennies on the dollar right now. You could never really do that, since World War II, prices for U.S. homes had only gone up to that point. And meanwhile, there were a lot of technological advances around that time, like the iPhone and the major advances in cloud computing and things that enabled somebody in New York, in Manhattan, to orchestrate the purchase of tens of thousands of homes from the courthouse steps. That's very complicated. You have to be there in person. You have to pay with cash. So, you have these multi-billion-dollar real estate investment firms literally sending people, buyers around with duffel bags of cashier's checks in different amounts so they can buy houses around Atlanta and Los Angeles is a big area, especially the Inland Empire, Riverside, and those places. Areas around the Bay Area were popular. Phoenix, of course, and Las Vegas, and all these sort of big booming places where there were a lot of homes that were foreclosed and available for very cheap. And so these companies, bought them. And the question at the time was, the rental homes that's an ancient business, but no one had taken thousands of sort of far-flung properties and been able to manage them efficiently. But as I mentioned, those leaps in sort of mobile technology enabled not only the sort of the land grab, so to speak, the purchase of all these, and we're talking Blackstone Group, the world's largest property investment firm. They were buying $150 million worth of foreclosed homes in a week, just to give you a sense of the scale of some of these operations. And no one had ever done this before. Apartment owners said, look, it's hard enough to manage 50 doors when they're under one roof. Why would you want 50 roofs, let alone 50,000 or 15,000 or whatever each company was accruing? And these companies, there was a lot of doubt, but they have been able to manage the homes efficiently. They have been able to sort of institutionalize that segment of property, the single family home, like they had basically every other class of property before then. And that was sort of the final frontier for Wall Street in terms of property. They could buy the bonds backed by debt. They could buy, more bundles of mortgages. They could buy shares of home builders. They could do all these things to play in that, but they could never own the home itself. And, the other big question, besides them being able to manage these things efficiently and make money, the next big question was, well, once the homes, return to their pre-crash value, will they just sell out and liquidate? Is it a trade or is this a business? And it didn't take many years from when they started buying homes at auction around, early 2012, maybe late 2011, that, they quickly realized they had a profitable business, and they've kept buying since then, even as home prices have hit, record highs in basically every market in the country, save for maybe, New York and some other sort of anomaly markets. They're buying less these days, probably in California, because prices have risen. Their money can go a lot longer, and the yields renting homes are a lot better in places like Denver and Phoenix and Las Vegas and Dallas and Atlanta. But they've continued to grow. And since the pandemic has happened or hit, there was a big question right away. Oh, will their tenants be able to pay rent? Will they have, a lot of problems? Will they have to do mass evictions and write off bad debt? As it happened, because these companies, the largest of them and the most sort of well-funded by Wall Street, they focused on a certain type of renter, which was generally somebody in their late 30s, early 40s, a parent, single or dual income. They were making, bringing in $100,000 more a year. And that's now like sort of the work from home class as we see, and not dependent on sort of or not nearly as affected by the shutdown of the service economy that we've had. And their business models have proven tremendously resilient. They have record occupancies now. They're raising rents faster than they ever have before due to the demand for a single family home. People like me in my little Brooklyn apartment that are, maybe have children and they want to just get out they can work from anywhere in the world. So they want a place with a home office and a yard. And basically these landlords now can name their price on rent, and these companies that now manage, anywhere from 20 to the largest as 80,000 houses across the country. So these businesses are in a tremendous boom time. Wall Street has taken renewed interest in the business that it helped fund, and you're seeing billions and billions of dollars since the pandemic and since the economic shutdowns flow into these companies so that they can build and buy more houses to become rentals. And they don't have. They'll make the case that they don't influence the market on a whole because they're only in certain markets, and they really do only have a sliver of the overall rental home, single family rental homes. There's something like 16 million rental homes in the US. The biggest companies combined probably have 400,000. But where they do buy is highly specific, highly concentrated. There can be certain subdivisions or certain zip codes where, they might own 15% of the homes between 2 or 3 companies. And then there's whole states where they don't own a single home. And you can sort of imagine the patterns of where these are. They want homes in really nice school districts to attract parents, and places where the parents will keep paying a little bit more in rent each month rather than move out and remove their children from these schools and from their neighborhood friends, and all the reasons that people like to stay in a home for an extended period of time, especially when they have children. And so these companies are really in a heyday, and this pandemic has, rather than hinder them like it has many businesses, it's acted as an accelerant both in their demand for their product and for the demand from sort of Wall Street, property managers sitting on tens and hundreds of billions of dollars who are looking around at office towers and shopping malls and saying, we don't want to invest in any of that. The future of that is very uncertain. What it is certain is there will be demand because of the just pure demographic and population growth. There will be demand for US single family homes. And a lot of people, particularly in the millennial generation, won't be buying. And some of that's by choice. People now, they don't own a music collection. They don't own books. They don't own their own car. They might even rent their clothing. And so there's some generational attitude things or sort of psychological things. Maybe they saw their parents, or maybe like me, they went through the housing crash, and it was such a tremendous shock to their finances and just sort of put them off of home ownership. But more likely, they're not going to buy because they can't. And millennials are one of the most educated generations, but they're also highly indebted. So you have people that can make a good salary and pay a good rent, but they have a really, really hard time coming up with that down payment because of all the student debt they're saddled with. You're talking, 6 figures of student debt. So it makes it really hard while they're renting in the cities that, they have to move to in order to make those good incomes. The rents are high. They can't really save for the down payment. Home prices keep going up. They can't ever really catch up with their savings. And so these folks on Wall Street see that coming. They look at the numbers and they say, these people are going to make a good living. They're going to want to live the same way they grew up or the way their parents lived with a suburban home, but they're probably not going to be able to afford to own it, or they might not want to. We at the Journal, we've done stories about the rise in renters that make 6 figures or more. Generation ago, those people are buying houses, no question. Or the vast majority of them. Now you're talking to people that even when they have the means and they can afford to buy a house, they're not confident enough in their employment, or even if that their employment will remain in one place. We talked to people who were, barely 30 and they'd lived in 4 cities for the same company, so there's all these things happening that are making home ownership a little bit more out of reach for most Americans, and also maybe not as desirable as it was for the past. And of course, the big problem that interests us at the Wall Street Journal with that is that Americans aren't great savers. Maybe you all are, but most Americans do not save money well, and they usually only do it by accident when they pay their mortgage every month. So if you don't have home ownership, you have all these questions about how people will sort of retire. Since World War II, we've sort of made the home the piggy bank, for better or worse. And it's worked for generations. But now we're running into a situation where, people who have homes and are counting on some younger family to come and buy their house, they might have problems getting the price they need or that they had expected to sort of fund their later years. The young family going up might never be able to buy a house because they're renting and they're not, accruing that equity. So at the Journal, the rental business, while still fairly nascent, I mean, these companies aren't 10 years old. They're fascinating to watch for us. And I felt worthy of a book to describe their emergence, because they're a new thing in America. And 2, their business, the quarterly earnings report from one of these companies can tell you probably as much about America at any given point as any other sort of company's business results. So we just find them very fascinating. And plan to really continue to watch these companies and write about them, and maybe not even like the company's intentional effect on America, but what their evolution and their emergence means, and sort of how it's affecting, you know, everything from neighborhoods to you know, mortgage finance and things like that.
That's really interesting. Ryan, could you just plug your book for everybody, the name of your book and where they would buy it, and then we'll do some
Yeah,
questions.
the book is called Underwater, and they subtitled it How Our American Dream of Homeownership Became a Nightmare. And that's actually a line that was cribbed from a very influential Wall Street analyst. A group of them who worked at Morgan Stanley early on in the crash sort of identified the potential for buying homes for pennies on the dollar, foreclosed homes, and then you know, fixing them up and renting them. And that was a sort of a line from that research that sort of got Wall Street thinking about this and started this new home rental mass landlording business.
You know, I'm going to ask the first question, if I may, since I'm unmuted. And that is, we were very much involved in fighting this controversial bill in California called SB 1120, written by a couple of very gung-ho legislators who believe in upzoning, in more and more density. And this year was interesting because density was becoming unpopular, and telecommuting was becoming really popular. And you never heard a word about it in all the hearings all year long in Sacramento. It was like a kind of a blinded, we really can't explain how and why they were so disconnected. But anyway, this bill came along, we fought it pretty hard. It only died because at midnight on August 31st, at the very last few minutes that you could approve a bill in the year 2020, a few legislators talked very, very slowly when the bill was coming up, and they, you know, got in arguments and they ran out the clock. And so even though it got approved on the assembly floor, there was no time for the runner to take the bill, physically take it, run it over to the Senate, and have them do a approval called a concurrence. There was a lot of politics on August 31st at midnight in Sacramento this year.
That's a very dramatic finish. I've never heard of a bill not getting. It's like you go to pick up your like or hand in your paper at the buzzer or something.
Oh yeah, they missed the buzzer.
The library.
Yeah, they missed the buzzer, and there was, you know, there was stuff going on, you know, behind the scenes that we have found out about later. But we fought it really hard. We had a huge number of people involved in writing letters and so on. And one of the fears that we had and still have is that if you allow upzoning of all single family lots in California, and this bill was called the duplex bill, but in fact it was four units where one unit sits right now, detached, 4 feet of air between them, which we call non-defensible space because of all the fires in California. But anyway, and then you could add what are called granny flats or accessory dwelling units, they also call them, so that you could either have 6 or 8 units where one house is now, including 4 homes, no requirement for any garage and no yard. And so we thought that this was opening up a whole new kettle of worms that nobody could possibly understand the outcome of. It looked really radical. There's one city, Minneapolis, is experimenting right now with duplexes, and there's been a real dead market for it. They've only had, I guess, 5 requests because of the economy. And Oregon is going to go to duplexes on single family zones in a couple of years. They're going to bring it in slowly. They've already approved it, but nobody anywhere is talking about 4 instead of 1 house, and nobody is talking about 6 or 8 with granny flats. So it's radical, and we're going to fight it again if it comes back up. But from your perspective, would this, I mean, one of the things we're worried about is that investors are going to buy these single houses and they're going to turn them into incredibly lucrative properties with 4 to 8 units on them in really good school districts like you're mentioning. And there's going to be upheaval.
Yeah, I mean, I don't follow California legislation much, but yeah, that would be, presumably that would have, anytime you can take a one and make four, especially in an investment situation for your yield of, I've reported in from Cleveland, which is again a far, we're talking majorly different numbers and different sort of housing problems. But if you can get an old house and it's zoned for a duplex over a standalone, that's much more lucrative and more attractive to sell to a rental investor. And one thing, there's a lot of money available to even individual investors. These companies that I'm talking about, they wouldn't do that. They're more likely to go out and find attractive land and build a whole subdivision of rentals outside of Phoenix somewhere, or if a house in a neighborhood they like hits the market, they'll have, they have these computers that tell them, the agent won't even have time to pound a sign in the front yard before they know they want to buy it, and they'll have an offer. So they wouldn't be the type to do this sort of thing. I would think that'd be more of like sort of an individual, a smaller scale investor. And what you can do, and it'll be interesting with the incoming Biden administration, one of the things they've talked about is eliminating the 1031 tax. I guess it's a tax benefit or a tax loophole where you can sell a property and not pay capital gains if you reinvest that in another property, particularly income producing real estate. So you'll see like a place like Cleveland or South Bend or Akron, these places with very cheap homes. You'll have Californians who bought maybe an investment property at the bottom of the market after the crash, have realized a big gain, sell it. You can take the profits and you can buy a dozen places in South Bend, Indiana that produce a certain yield on your investment. So, you could have investors like that look and take a house and tear down. And I would think that would be more attractive to somebody working on a smaller scale than a company with 80,000 houses or a private equity firm that has to put money to work in increments of $100 million to be efficient. And we see that here in New York where, we're all around me. It's the talk of the death of New York City. I'll tell you, it's been pretty exaggerated. I don't know about Manhattan, but here in Brooklyn, there's construction cranes everywhere. Pretty much any sort of, if you found an old single family house, it's going to get torn down and become a 4 or 5 story, apartment building or condo. But yeah, the fight over upzoning property is an old one. And when I was working down in Alabama, that it would be so extreme. There'd be an old beach house or a row of beach houses, and the developer would come and, make a deal to buy them, and then go to the city council and say, well, I want to build a 30-story tower with 500 condo units. And, you go from 5 little beach houses to the biggest building in the state. And then, what happens if you're the owner of the 6th beach house in the row, and your new neighbor is a 30-story glass, tower that's under construction for 2 years. So, yeah, I think anytime real estate prices are rising like they are now, California has sort of that notorious shortage of affordable properties. So if investors can get in there and convince folks, in the zoning, whatever governmental body is zoning that, hey, look, these will be for moderately priced. That'll be the key, right? Affordable housing, which, can range from truly affordable to somewhat, lawyers and developers will throw around sometimes ridiculous upper bounds to what affordable means. But yeah, you would almost certainly, I would think that what you're envisioning happening would be a likely outcome given the dynamics in the real estate market today, both on the investment side and the demand side for housing.
That's interesting. Everybody who just heard you say truly affordable really appreciates that term, because we use it all the time to mean that it's for low income people and below and very low income people. And sometimes we look at bills that are meant to help moderate income people, and everything else is market rate. And in California, market rate is not affordable. No, I mean, your average person, even 2 people working in careers can't afford the market rate stuff that's being built. So
Right.
it's kind of unclear who's moving in and who's buying the
Same
market rate
here.
housing. What?
I said same here. It's, you see these towers going up and you're like, well, there's no, the incoming classes of bankers and lawyers and actors, and so they're not coming this year. And the ones that came last year have left. So you're wondering who are these towers for? Who's going to live in them? We had talked about the idea of trickle down, which is popular in California, and it's I was joking with my girlfriend later that, I hope with all this construction, a place that with a dishwasher and closets will trickle down into my price range. So just to give you an idea of sort of the affordability issues of even professionals in New York City have and face, which is, I'm sure, very similar to what's going on in the big cities in California.
Well, we love your candor.